Good morning, good afternoon, and good evening to all of you who have joined this webinar. Really excited to see you. I think Joydeep and I today join you from two different parts of the world. I am sitting here in sunny Istanbul, and I think Joydeep is in the New York area, which is where we are both based. But excited to be here with all of you. My name is Sumit Salwan. I am a co-founder of CEO Works, which is the firm that we call ourselves the Talent to Value Company. And it's a firm which is based on building this IP around how do you assemble enough talent at points of value creation, as opposed to points on the hierarchy. And today, Joydeep and I will share very briefly about this concept, and more interestingly, a real case study of how this has been applied in the context of something that many of us are facing right now: high inflationary environment, a real need to actually cut costs and not think of value curves only in what I call going to the right and going up, but at times when they are going down, how do you bend the curve the other way using the principles of talent to value? Briefly about me, I have spent a large part of my career with organizations like Unilever and Johnson & Johnson. And over the last 4 or 5 years, we have sort of married the learnings from what I call supply side talent in these large academic companies to real demand side requirements of the private equity world. And which is where CEO Works was born. And we do a lot of this work in the private capital space with mid-market PE firms, mega funds, and also with family conglomerates. So I'll stop here, and Joydeep, maybe let you do a quick introduction and we can get on with it.
Hey, thanks, Sumit. Morning, afternoon, evening, everybody. It's a pleasure to connect with all of you on a topic that's so relevant today. My name is Joydeep Matsuri. I'm a senior partner at the firm. I've been with the firm a little over 18 months now. Prior to this was with the KKR portfolio company, a $6 billion healthcare portfolio company. Applied this there in a limited way, and it worked really well. And similar to Sumit, a long tenure in corporates such as Becton Dickinson, Coca-Cola, and GE. But again, welcome to this webinar. I'm really excited about talking about how can we be a little more intentional and use talent to value to realize efficiencies to ultimately drive growth in a tough environment. Sumit?
Great, thank you. So maybe we will start with the success formula for private equity. I've always believed that keeping it simple has been at the heart of things. We build a value creation plan. We spend a whole lot of time on C-suite selection, getting the right CEO, the right CFO, the right chairman, etc. And then there is rigorous performance management through monthly operating reviews and so on and so forth of all the initiatives, which we have created as part of the value creation plan. It's all strung together with the MIP, or the management incentive plan. And I would say the superpower of the private equity world has been, and I can see the contrast with the corporate world that I grew up with, a phenomenal alignment of incentives. Management and sponsors are completely aligned on incentives, which may not always be true in the public equity world. So this, I think, these 4 elements put together have created outsized returns for the private equity world, would be a submission that I would make. The thing that we have seen vibrates a little bit in this is this, I would say, over focus on C-suite selection. I don't know if this is a statistic you guys have heard of, but there is a 73% failure rate in CEOs in the private equity world. So 3 out of 4 people, after they get selected, don't make it to exit. 58% of CEOs, and I use CEOs as a proxy on C-suite selection, saying that's probably where you put the maximum effort. So 58% of CEOs don't make it within the first 2 years. So I would say that's a little chink in the armor here okay, saying, look at the amount of time we spent on C-suite selection, and there is something about that part of the atmosphere where there is a very high defect rate. What we've learned as the CEO works team, if you just go to the next chart, is that along with this C-suite selection, what we need is a talent to value plan. Not just the CEO and the CFO and the chairman and the CHRO, etc. But what are the 15 to 20 roles in your investment directly linked to your value creation plan, where if we got stunningly good talent, you would bend the value curve. That's the basic thesis of talent to value. That's the basic idea, that between your value creation plan and before you start performance managing, scorecards and so on, have you built a talent to value plan where you've identified a list of critical roles which are doing those critical pieces of work which will bend the value curve. Let's talk a little bit more about this idea. So every idea will ultimately just become an article or a book or a webinar unless you convert it into a process. Let's go to the next chart. And the talent to value process is a 5-step process, which, and I'll go very quickly through it because the idea of today's talk is less about getting perfection on how to do the work, but just to give you a sense of how the concept gets applied. So this idea has got a 5-step sort of routine. The first one is about the value. It's not about the talent, but it is about understanding the fewest points of leverage where we have to get the activity systems right. We call them the value hotspots. And is there alignment? We'll talk a bit more around alignment on this value agenda. The second step is about identifying the roles that have a disproportionate impact, the fewest possible roles which have a disproportionate impact on this value agenda. The third step of this process, and you can see I'm going from left to right here, is what I call the heart of the process. We call it the click. This is where the role and the talent click into each other. And this is not a talent process because I'm on step 3 and we still haven't talked about talent. We've talked about value. We've talked about roles. And it is in this third step that we figure out what is it that we expect from this role? How is the role designed? And does the talent click into that context? And what you identify through the gaps on these 3 things is the execution risks to value. Far too often we spend time thinking about execution risk only in the context of talent, that if we get the best person on the job, everything will be fine. And what we've learned in this process is understanding the expectations from a role, looking at the design of the role is 2 times more important than actually figuring out who's actually doing the work. More on that, with an example very soon. When we've done that for one role, which is in step 3, now imagine doing it for those 15 to 20 critical roles, and you start seeing the patterns of these execution risks. And step 5 is about what we call mobilizing the returns, which is now that I've examined this problem in full multicolor across the first 4 steps, what am I going to do about it? So one important thread that you should see running across these 5 steps is the word fewest possible, the fewest leverage points, the fewest interventions to unlock value, the fewest roles which will have disproportionate impact. And I think this is an underlying theme on this methodology, which is not, let's look at everything you could ever do to drive value creation versus looking at the fewest possible things which will bend the value curve, okay? And let me try and talk that through with a little example. So this is a business we've worked on for about 2 to 3 years. It's a second round PE owned company, which has, does refrigeration and sort of commercial establishments, refrigeration installations and repair. So it's a pretty grungy industrial product business. About 50 million of EBITDA, 460 million of value at which it's been bought. And round 1, as in 16 to 19, was all about a roll-up of other mom and pop founder-led organizations and driving an EBITDA arbitrage. Round two, which you see from 19 to 23, even now the biggest hotspot is M&A. So yes, there is a continuous thought about buying these companies and bringing them into the mothership. But if you look at all the other hotspots, which was the pivot on this value bridge, they are all about driving operating leverage, because now there is enough scale in this platform that it's not just about buying things and selling them off with a multiple arbitrage. You had to drive operating leverage. So if you go forward, how do you get to that list of critical roles? And before that, maybe I'll talk about alignment. When you look at this bridge, we often find it's not just a math exercise of understanding value drivers and value hotspots. There is a set of things that are in the investment thesis or the underwriting case. There is a management case. The CEO has their own points of view. Then a consulting firm will come and build you a value creation plan, or your operating partners look at ambition. And now you have all sorts of numbers and value bridges which are floating. Some of them are a secret. I can't talk to people about it. So how do you actually drive alignment when it comes to talent allocation? Should we be allocating talent in terms of points of value creation to the management case, to the underwriting case, to the value creation plan? And the thought that I would just leave you here with is, where we have seen massive success, and probably that's the only way to do it, is you have to allocate talent to ambition. You cannot allocate talent to a budget. There is no way you are reaching that ambition if you haven't put the right size people in the right spots. Okay. And I think this is an interesting sort of thing that you will deal with as you build these talent to value plans, but more on that later. How do we get to this list of critical roles? So if we go to the next chart, as I mentioned, the largest value hotspot in this company was M&A. So it's a very simple thought, not very complicated, no 2x2s involved here. I would want you to think about a metaphorical table getting dropped on this value hotspot called M&A. And you wouldn't be surprised that the people sitting around that table are what we call the critical roles. The head of M&A is there. There is a director of outbound who's sourcing deals. There's the CFO. There's the VP of sales and marketing who brings you insight and so on. And there's a head of integration. Just take that as an example. These 4 or 5 roles are critical for the 750 million of value creation in this 2 to 3 year period. And thereafter, I find it really interesting. How do you build a value rank list of roles? We do an exercise here of actually, if you could just go back one chart, of allocating 100 chips across and ensuring that this 750 million, in the eyes of the CEO or the operating or deal lead, in this case, is the VP of M&A more critical than the CFO? Or actually capital is a real issue and therefore the CFO's role is more important? Or ultimately actually getting deals and doing them is easy? Most of the value is being generated in the integration. So how those 100 chips are distributed across this table can vary from situation to situation and is very bespoke. But it gives you a sense of what I call the size of these roles. Okay. For some of you math majors here, I would encourage you to not think about this in too much detail for now, but just, if you let go from a process perspective, I wanted to give you a sense of how do we get to the relative importance of these roles at this point of time. So when you have to prioritize your energy on where do I have to go first, it gives you a sense of that even within this small list of 20 roles, all of them are not equal. Yeah. So in this case, when we drop the table across the 5 or 6 value hotspots, you will see on the next page that we get a value ranked list of roles, which, no surprise, starts with the VP of M&A at the top and, goes all the way, to role number 19 and so on and so forth. This list typically has a lot of insights. We will, in 90% of the cases, see at least 15 to 20% roles that don't exist in the organization, which shouldn't be a surprise, because if you're trying to bend the value curve, you have to be doing new work. And if you're doing new work, who's doing it? Otherwise, what is the reason that the momentum will shift in the investment? And the second most important thing, which you see by level, at least 3/4 of the roles are not the direct reports of the CEO. They're not N-1. They belong to levels which are deeper down. The part which I really love, which I was saying to you earlier, that is this now a new list of some 471.83? Like, what is this sort of clunky mathematics which is mentioned here? As I said, if you just step back from it for a second, and Megan, if you could just go to the next chart, what you can see on this list is that the HR VP of talent acquisition is almost, the role is valued at 161, is like number 3, and is many points above the CHRO. So what does that actually mean? Does it mean that the role of the CHRO is less important? And the answer is no. We're not creating a new hierarchy here. All we are giving the CEO of the business or the deal operating lead here is a rank order of how you should spend your energy when it comes to talent allocation. In this particular investment that I'm talking about, they were gasping at this stage to hire 500 trained technicians to get out into the field to actually do the work. As they were running this roll-up machine, they had to go from 500, a critical piece of work was to go from 500 to 2,500 trained techs. If you didn't put a genius on talent acquisition to actually fix that and do it quickly, having an awesome generalist CHRO is important, it's great, but you don't want to run a trickle-down theory of talent management. Let me appoint the CEO, they will figure out this CHRO, the CHRO will figure out the head of talent acquisition. You're leaking time here, even if it works in a best case scenario. So all this list gives you is, through the value rank ordering, you figure out, my God, this is a particularly important piece of work. And I'm not talking about a 2,000 people organization where the CEO is trying to run a massive talent agenda, but my God, I have a business to run. Listen, this is 20 roles. And please don't ignore the rank order of these roles because it helps you get to the value faster, okay? So let's go to the next chart. Now that we have these critical roles, yeah, the first thought that most of us get whenever I tell you something is a critical role is to immediately go towards the talent. Who's in the job? Head of talent acquisition, very important. Okay, I understand your methodology, really impressed. Now tell me who's in the job. And like I said, step 3, which is what I'm pointing out to now, at the heart of this whole thing is, it's not just about the talent. Understanding the jobs to be done, which is what you see in the middle, the work, the 3 to 5 outcomes that will actually drive value for the head of talent acquisition. Is it about hiring a lot of new, TA specialists? Is it about finding new partners? Is it a technology play? What is the actual work which will deliver value, and are we aligned around it? And is the role set up for any human being to actually do the work? Do they have the decision rights to deliver this work? Do they have the resources to deliver this work? And so on and so forth. And what we found over time is that nearly 70% of the risk, having done this work across hundreds and thousands of roles, 70% of the risk actually sits on the left side of this chart, which means there's lack of clarity on the outcomes. There's lack of sort of edge in the design. And we spend 90% of our time trying to appoint people into ill-crafted, confused roles. Let's go forward. Please don't try and read this chart. I'm just giving you this as an example of what I mean by the things I said in the previous deck. So if you look in the middle are the 5 jobs to be done, and 65% of the value in this head of sales and marketing role are locked in establishing an operating cadence on pricing and getting a buy-in and adoption from all these mom and pop founder-led little businesses that are being. So establishing that discipline and driving this pricing is where 2/3 of the value in the sales and marketing role sits, okay? However, when we do the role assessment on the left-hand side, this role is over-reliant on convening and influencing rather than being able to direct people into this discipline, all right? There's an excellent talent in this job. So the right side of this role is all about talent. And you can see talent is all green. They have a huge readiness to deliver all the jobs to be done. However, the 165 million of value that we expected in this role is not going to arrive. And the reason it's not going to arrive is that in the assessment of the talent, there's one small little chink. Even though they are all green in terms of their expertise to do the job, they are slightly low on charisma and ability to influence, as evidenced by the feedback from the division presidents, the P&L owners. Okay, this is a real expert with a strong track record, all green, 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 but they lead with expertise. They are not about influencing. But in this role, 2/3 of the value is coming from influencing P&L owners who actually take the pricing decisions when they're talking to customers. So you can see just appointing a great person would not have led to value creation. And what would you do here? You're not going to change the person because you've actually got a really good person in the job. And by the way, you may not even be ready to change the role design because you don't want to take the power away from the actual salespeople who are facing up to the customers on making pricing decisions and closing sales. So what do I do here? Because I'm not in the business of only appointments, in this case, we did something really simple. We set up a meeting between the CEO, the 2 division presidents, and this expert. 45 minutes every 2 weeks where they sat and talked about 5 hairy pricing decisions. And now the role is getting some derived authority from the CEO, and you're beginning to connect that expertise into an actual outcome that is required in the business. And 2 to 3 months later, we started seeing, the money arriving in this pricing space without blowing up the organization or changing the talent. Okay. Now, most of what we have done, and I think I'm going to hand over to Joydeep here, so Megan, we can flick through the other charts. Most of the times, we do just one chart back. We spend, talent to value in building something like this. 500 million of value today, 2.5 billion of value tomorrow. You've all seen this. And at each hotspot, we are connecting talent to the critical work. And we are washing away the execution risks over a 3-4 year period and executing this talent to value plan. I think the interesting thing that we learned with one of our clients, and we've been doing a lot of this work recently, is talent to value. And these principles are not designed only for organizations which are sort of looking at high growth opportunities and so on and so forth. Joydeep will talk you through a case study where we use the exact same principles, but actually to drive hundreds of millions of cost efficiencies and thereby driving growth. So Joydeep, over to you.
Hey, thank you, Sumit. So as Sumit rightly said here, this case study I'd like to focus on is a company that called us in the summer of last year. Just to give you some context on the company itself, a consumer packaged good company, recently acquired by a PE firm, but also a very large individual active investor that bought the company. It was only the North American business, a new CEO in place just 4 weeks in the role. The portfolio itself is highly commoditized, very, very price sensitive, very competitive because the number of players, both big and small, and even homegrown, and has a seasonal curve in terms of consumption. There's lots of disruption happening in this space with the focus on health and wellness. So there's smaller, more nimble players in the market that are biting at share. And this company was part of a much larger global organization and therefore tended to operate more in silos. When we got called in, the CEO was clear saying, need your help to really look at efficiencies alone. And as a firm, even though we've grown up in a world where ratios matter, where staffing ratios are looked at, given our backgrounds that Sumita has spoke about, we took a slightly different approach, saying, how do we apply a value lens to driving efficiencies? The employee base, before I talk about how do we do it, the employee base here was also quite affected with the sudden change from working for a large, quote unquote, secure global company into a new ownership status. And with this shift, there was a huge attrition already in play in areas that are very critical to growth. And we walked in quickly realizing that would be a concern for us to deal with. Given new employees, new ownership in place, there was visible employee discomfort saying, are there more cuts coming? And this was in the context of a company that was fighting on price for a long, long time. And therefore, to keep margins still robust and competitive, had engaged in 5 years of cost cutting. So that is the context with which we walked in. And as we began to review the VCP, the plan was quite aggressive, saying we need to more than double the EBITDA in about 5 years or less. Within that, to really reorganize investments, there's a clear target of looking at cost savings. There is a combination of both headcount and non-headcount expenses to about $200 million. And at the same time, continue to participate in this category, this highly, highly competitive category, to grow ahead of the category itself at 3% or more. So if you take a pause and look back at this, it looked like this wasn't an easy thing to do over a long period of time, but we had 5 weeks to deliver this. In our favor was a CEO who was brilliant, we thought, was a VCP that was quite clear, and yet alignment between the new owners, the CEO, and the critical mass of employees that would drive this change was not uber clear to us. And we knew for the money to drop, for this $200 million to arrive, without alignment and a value agenda to anchor it, we would make little progress in driving this fatigue out and being high energy in creating this new organization. So when we looked at the value agenda itself, next slide, please, we clearly were able to see, based on the VCP, there were certain cost hotspots. So let me start with cost first, given our mandate was to go and realize efficiencies. This is an organization, as I said, for a different scale, and therefore a clear high cost focus was in optimizing the manufacturing and supply chain, saying how do we right scale, right size, and have the right set of capabilities to participate in a market as competitive as this. So a huge chunk of focus was already there. Before we walked in, the manufacturing and supply chain organization had already delivered a good chunk of money back, and therefore they had their backs to the wall saying, is there more, and are we going to cut into the ball? Similarly, we looked at saying, how do we create more efficiencies in the G&A organization, and in that create more efficiencies in G&A, but also augment the effectiveness to investments in technology. So there were two cost hotspots that we looked at. But to participate in this market, clearly, there were certain growth hotspots. So the idea was realize efficiencies, but reinvest a chunk back into driving innovation and premiumization. We talked about health and wellness. A lot of the employee leakage that had happened and capability leakage that had happened was in brands, marketing, and innovation. This company is sold to a large number of retail organizations, sold through retail companies. So how do we build both category share in retail as well as depth and volume in the retail organizations they partnered with, and re-augment the way they partnered with the retail companies? A size of the business was also actually going directly into home. So how do we create value? By really looking at the way the talent organization structured the go-to-market for in-home consumption, and looked at different cost efficiencies there, but to improve more volume, more value, and more better customer experience through digital. So if you look at it, it's super clear that the EBITDA piece was a net deliverable based on cost realizations, but also a significant chunk of investment. What we found really powerful in this, given all the employee sentiments in place when we walked in, that the value agenda was a big piece in driving alignment, not just between the owners and the CEO, but also this core group of select leaders. So using this value agenda to say why these efficiencies were necessary for them to thrive again and do really well was an important piece that we engaged them on. So the principles of change that we came up along with this team, was saying everything that we do here in terms of efficiencies and effectiveness has got to connect to value and the value creation plan. And within that, we would look at all the critical roles that would drive value, even within supply chain and manufacturing, in HR, in finance, in IT. What are the critical roles that will drive value? And what are the ones that would actually leak value? And therefore, which roles would probably be not as relevant in the value agenda moving forward? And that drove the optimization of the headcount. We also talked about, when Sumit was talking about dropping a table on the value agenda, based on our experience, we've realized that value tends to occur between tables. There are strong interdependencies. So therefore, when you look at siloed organizations, we had to go and hunt for what are the processes that drive effectiveness and efficiencies across tables where value tends to occur. So we were on the hunt saying, as we organize this change process, certain critical business processes will be very important for them to function well and define what we call a new operating system for the effectiveness of value to occur. And finally, given all the nervousness around the big change, 5 years of cost cutting, preserving talent and knowledge would be a big piece. And he made that uber clear, saying, as we design the roles, make sure the roles functions well. So the role design process, but within that, how do you make sure that talent that is valuable and the inherent knowledge that they bring to the table is preserved through this change process? Sumit, anything you want to add here?
Yeah, thank you, Joydeep. I think one important point here for us to keep in mind is, like I said, most of the times when we have used talent to value, it is about driving growth. There's just a bias in the process that people are looking at what drives value and where do I need to put in new people and so on and so forth. I think this is an interesting line of thought, and it's almost like the mirror image of talent to value. So if you have to cut 30% of the organization, where should you not cut? Where is the value getting created? And therefore, the mirror image of that is where you cut. And the second thing that we saw in this business, if you recall, Joydeep, was every organization had been given like a target by the sponsor and the CEO. So every function had their own like thing they were working on. So this third principle of identifying organization overlaps is not just about cutting, it was also about connecting. So if the customer organization decided that, listen, we will focus on the customer and all the shopper marketing piece, I'm just taking it out. It's not core customer. I'm not going, this is how I'm delivering my headcount target. And the marketing team decides, we are going to focus on core brand, work because we are marketing. So who's doing shopper marketing and where is that falling through the cracks? Because it is a driver of value, right? So I think this value agenda that you see, that where do you want to grow, innovation and premiumization or winning at retail, etc. Where you need to grow is something that needs to be woven into these cuts, and is the organization sort of connected to each other through this value agenda as we try and drive the efficiencies. I think those two things were quite interesting, yeah, for me. Back to you.
Great. The next slide, please. So as we did this, we made sure, this wasn't just, as we said earlier, not just a cut in terms of labor or headcount. We made sure there was strong alignment to the value agenda. So whilst you're reducing the back-end dollars, you're not cutting the roles that are important in driving value at the front end. So how do you make sure that cut is realigned to driving the front-end structure that will drive growth? How do you make sure that you're realizing the efficiencies to build and strengthen what is going to be a huge growth driver was innovation and the direct-to-consumer marketing, the digital solution that they were planning to put in place. To link all of this together, a clear driver for us saying was to strengthen the operating model. And therefore, it was very apparent to us saying stuff like sales and operations planning, the demand planning process was something that this company needed to really strengthen. And through the work of this 5 weeks, a team got put together, a table dropped on creating a new S&OP process for this entity. And that really helped through saying, which are the critical roles across functions that never spoke to each other in driving this crucial process. That was a new part of the operating model that suddenly came into being. Similarly, as Sumit was alluding to, what are the roles that there are table that would drive channel and customer activation? Because now you are creating new channels to go to market. You are significantly altering the retail service organization. So how do you make sure that they were supported by backend functions like quality, by innovation, to really create value in those customer and consumer segments? And at the back end, we figured out that the brands and innovation process wasn't in place, even though it was not our mandate. It was very clear that a cross-functional team needed to come together to really focus on driving a new innovation process. So I identified 3 areas that would strengthen the operating model. And then going back to what we do in terms of talent allocation, it was clear to us that there were 4 or 5 areas that the firm needed to really build new roles and augment capability to drive those growth hotspots that we referred to. So it's digital, clearly focused on pricing and making sure as we went into retail that net revenue management was looked at through a magnifying lens, getting new talent and new capability into those roles. Quality, because of this 5 years of cost cutting, was a reduced function and was beginning to augment in terms of customer adoption. So really amplifying and building quality was a pure area of focus. So saying what are the critical roles in quality that we need to build up? How does quality really focus on powering innovation and channel activation? So it was a very different quality structure they came up with, which was an investment thesis as opposed to reduction, and also investments in consumer analytics and insights. So I identified these 7 or 6 odd really critical talent areas and roles within them for which they needed to really invest. So using these 3 pillars, we were able to come up with a map saying where do you cut and how does it not dilute your value agenda and yet yield this higher EBITDA over time that you're aiming for. So having done this, using these 3 pillars, the net results were quite good. So if you look at what we looked at in day 1 and day 35, next slide, please. So on day 1, we were staring at less than $500 million of EBITDA, actually much lower than that. They had already realized $35 million of labor efficiencies through target setting alone. But there was low engagement. People were nervous about targets going too deep and becoming a crippling action in the future. And growth functions like marketing, digital were under stress. In day 35, using the value agenda, the concept of the role design, and the talent readiness, we achieved 6 things. 1, super clarity and engagement on the value hotspots, saying, why do we need to cut here and what would that feed? When the leadership was empowered with that clarity, they actually went and over-delivered on the ask on headcount. So as compared to an $80 million ask that we had internally set up, the team went and outlined a plan to go after 85 million with possibly another 3 to 4% on top of that, which stunned both the sponsor and the CEO. Through this process, as I mentioned earlier, given the frequency of the meetings that we set up, this was only 5 weeks between the teams that were doing the work, between the CEO and the sponsor. There's a strong alignment on what is the right number to strive for and what is the right cost to go after, and a real focus on process clarity. Those 3 processes I spoke about, saying what do we go after first, the fewest possible things, fix S&OP, go after customer and consumer activation, build the whole brand and innovation process with a clear cost action ownership that we put in place. So this was in 5 weeks straight. As always, we like to keep in touch with the customers, and after a good 18 months, this is where they stand today. EBITDA has actually galloped really well. They're 1.5 times where they were earlier. The attrition has come down to market levels. They have a plan to go at better than market. They were able to reinvest about $100 million in new capabilities. So if you look at the transition from day 1 to day 35 to day 50, our learning as a team was simple. Saying 1, when we went in, we were very conscious of the VCP, what would create value, what would a large organization feel like when taken over by a more nimble, PE firm with a large investor and a new CEO? How does the value agenda engage and align leadership? And then how do we create a framework and a wireframe within which leaders could actually take calls on where to cut and where to add? So it became a very, very dynamic, active process through which we sought decisions and drove this outcome of more than $85 million in cost savings. Sumit, let me give it back to you. Any closing comments there?
No, I think I would just bring back the talent to value foundation here, which is we've spent a whole lot of time over the last 10 plus years on thinking about how to allocate talent to points of value creation. This was an interesting exercise of saying, how do I cut talent away from points of value creation, but using the same lens and the same process in mind. So I think I would love to just now hand it over to the team for questions and thoughts and reflections. Maybe we can have a short conversation.
Thank you both so much. That was a wonderful case study and wonderful overview. We have had a number of questions. Hi, folks. I'm Megan Bluen. I'm an associate partner at CEO Works. Realized I didn't introduce myself at the beginning. Joe Hunt had a question. I think it was a really good one at the beginning of the presentation, and I'll put it out to the both of you. Many of us on the webinar are executive search consultants who are not in need of more work. It's good, but have skin in the game and want to help our portfolio CEOs run a Pareto analysis over their org chart to proactively assure that they have the right people in the right seats at the right time. Most of us don't have an HR leadership background. How do you recommend that we help facilitate this work from the roles that they're in?
Great. Hey, nice to hear from you, Joe. It's been a really long time. The thing, Joe, here is most of us on this call also may not be from an HR background, and in fact, Megan, for example, has spent her life on the value side of the equation and in finance and strategy consulting. So, but jokes aside, there are two or three things you said here. The first is I agree with you. This is not about an HR process, right? This is the core job of a CEO is to make talent or capital allocation choices and talent allocation choices. This is a process that connects the two. And what can you do to help your CEOs? The first thing is, I think as a search consultant, you will have to go beyond the business of seat empty, seat full, right? Our research on more than 100 plus CEOs in portfolio companies that we have served, there's something really interesting we found. The two core reasons for CEO failure, that 73% number that I talked about, which was actually from an Alex Partners research, which was published in 2017 or 2018. But we ran something similar, in the portfolio firms we serve. The two biggest drivers of CEO failure were, number one, not allocating enough talent at the problem quickly enough. Think big, start big, move slow, get fired. And versus think big, start small, and move fast. So this Pareto analysis that you talk about is a really, really powerful thought. But you have to then go beyond appointing the CEO into helping them understand that it's really critical for them to understand those points of value creation and allocating talent at those points quickly enough. Do I have enough talent at the problem? The second reason, by the way, was trying to do too much. Initiatives ranging from, every time I see a list of 149 initiatives with scorecards and so on and so forth, these undermanaged, slightly underperforming assets, which you bought really well because you're an awesome deal person, there's a reason they were underperforming and undermanaged. They can't digest all these initiatives. So initiatives to run the place, to grow the place, has to change the place all at once. Back to the same thing. Think big. You'll start big across all this. You'll set up a program management office, you'll a chief transformation officer, and then all of them are just bouncing off the capability and capacity of an organization. So really understanding these 2 points, and I would say guiding your CEOs in the spirit of not looking for more work that they are failing and the search team is busy, but really driving huge success with skin in the game. You will have to go beyond search into an advisor role and make sure that they are doing this job. I don't know if that answers your question, and I'm not sure if it's possible to have a conversation in this format.
I'd like to add just one more point to what Sumit just said. As a search partner, making sure whoever you place in the role is going to be immensely successful will require 2 things. Is one, you probably do this already well, is you really understand the valuation and where this role fits in. But as we mentioned earlier, when 70% of the success in the role lies in the role design, you might want to engage in understanding, saying, is there enough in place to ensure the success of this person in that role? So is the role design conducive to success within the environment of the company? And that would be a huge value add that, when people are busy inside the company, they tend to forget. So making that upfront and clear would be a huge, huge value add.
Perfect. Thank you both so much. We have another question. So Jeffrey, I just sent you a message to ask if we still want to cover the one that you had asked. So we'll skip to Ajit's question for now. One key I've seen, this is from Ajit, one key I've seen in business and HR, one key I've seen them business and HR leaders face while thinking about critical roles is the very concept of getting to terms with the fact that all roles are not created equal in terms of business impact. This goes to the core concept of critical roles. Do you have any pointers on how to manage, communicate, and align on this? I think that's a great question, Ajit.
Okay. Maybe I'll start, and I'd love to get back to Jeffrey's other question in the chat as well about what needs to be true. What are the prerequisites to do this process? I think that's a really important question that I'd like to come to, unless somebody answered it on the chat already. My apologies if that's the case. So, Ajit, your question about how to manage, communicate, and align. I would say 70% of your energy first on creating the list versus managing, communicating, and aligning. Because creating the list, when done in the context of the value hotspots and the critical work that will deliver them, is where the real magic lies. What I have found is if we try and socialize this list of critical roles too much and get too much alignment on it, it very quickly gets politicized. So sitting with a full executive leadership team and saying, why are these, why these 18 roles? Are they going to get more MIP allocation? What's going on here? Let me just make an awesome case on why my role or my team's role is very critical. And I would only say align if it will help you move the value puck forward. Communicate if it will help you move the value puck forward. The thing which will be most valuable for you and your CEO, or if you are the CEO, is creating this list and saying, let me be very clear as I run the place. Just like you are crystal clear about your strategic choices, you should be crystal clear about the 18-20 places where you have to assemble stunningly good talent. The only reason you should talk about it to somebody else is that it will help in getting better talent at that spot. It will help in making the people in those roles more successful, and so on and so forth. I have found trying to get people on the same page and getting them excited about the list is an exercise in futility. And in any case, because your value agenda will shift, this list is going to shift in 6 months' time. Yeah. This is a continuous process. You don't make your VCP moves from when you started till when you end. Your talent to value plan will therefore also move as it moves, as the game progresses. Okay.
Yeah. So hey, Ajit, thank you for the question. To add to Sumit's point here, the key point being the risk of communicating this is exactly what Sumit said. Once your value moves, the role might not be as significant 6 to 8 months from now. So making sure when to communicate and why to communicate is ultra important, ultra important.
Okay.
Great, thank you both. Okay, we'll go back to Jeffrey's question. Before we apply this model, what are the prerequisites that we need? For example, clarity on what strategies will drive value and how much, estimated, anything else?
I think you've hit the nail on the head, Jeffrey. I often say to people, if you don't know where the value sits, you are too quickly onto the talent to value plan, because it starts with the value. Our firm, or we, are not math specialists or strategy consultants. So we work with our clients, with our CEOs, with our operating and deal partners, with, I would say an 80-for-20. It's never much more than that, by the way. 80-for-20 clarity on where the value sits. That is a primary requirement. The second one, every step of this process is a series of judgments. There are 55 things you can do to drive value, which are the 5. There are 1,000 roles which will drive value, which are the 20. There are all sorts of risks, are they big or small? So there is judgment being applied in every step of the process. One important prerequisite is, who do I make that judgment with? So half this process is with the client. If you don't have the right CEO, which tends to happen in, let's say, 5 out of 10 investments, we find ourselves working more closely with the deal partners and the operating partners at that stage. But to me, the prerequisite is you need to be clear about the value, and you need to have somebody either in the CEO's seat or a proxy of that who can help work through the process and make these judgments with us. Those are the 2 biggest prerequisites. Let's take the next question, Megan, if we have one.
Sure, we do. We have another question from Joe. Most middle market private equity portfolio companies don't have a true CHRO, and every member of the C-suite has to then wear a component of their own HR leadership hat. If the CEO isn't willing or able to drive running this Pareto analysis over the whole organization, what's your advice on each functional head, so finance, sales, supply chain, et cetera, doing it independently within their own vertical functions?
Great question again, Joe. I often joke about the fact that there's a reason we called our firm CEO Works and not CHRO Works, because we truly believe that this work needs to be done with and in service of and with the CEO. If you don't have a CEO who's willing to engage, either because they've got it figured or they don't know that they've got it figured, my personal view is that you are fighting an uphill battle here with a poor prognosis for success. So, especially in mid-market PEs, if you're talking about 30 to 100 million of EBITDA, I think the CEO's role is critical, and trying to do this work in a piecemeal way with a C-suite leader in supply chain or finance can be helpful. It will be helpful, but I think it probably will not move the needle for an investment like this. It should be quite easy to put your arms around a sort of 200 to 300, 400 million enterprise value firm, maybe 500, maybe 2 billion, but they're all smallish firms in terms of enterprise value. And I don't see a huge way around the fact that, is your CEO committed and excited about this process? I don't know, Joydeep, if you feel otherwise, but that's my view.
Yeah, I couldn't agree more. I mean, success in doing something like this is predicated on 2 key roles. It's either the operating sponsor and the CEO, but if the CEO is not on board, we always say, wait for the right time. We'd rather not go down that path, because without the CEO, there's little hope this will get traction and the value will arrive.
Great, thank you both. We did have another question come in. This one's not in our Q&A. I think we can maybe make this our last one.
Yep.
In practice, how complex is this process? How much time does it take? Do I have to work through the whole process to see value? Can I break it into chunks? Can you speak a little bit on that?
Do you want to take that, Joydeep?
I'll take that. Yeah, we work with our clients in terms of what are the problems that they're trying to solve for. Some clients are very happy to just get a list of critical roles, right? We also do, as rigorous as this sounds, there's a certain discipline at the back end. We do have a digital tool that makes it a lot more easier, but we also have a rapid way of doing this where we're able to mobilize and action outcomes that are very evident by the time we do the critical list. So mobilization tends to occur a lot earlier than waiting for it to happen after step 5. It only gets much sharper, much more specific through the process from step 3 onwards. Your question around time, we'd say between 12 to 16 weeks, depending on the approach that you want to take and the skin that you want to put to the game. Some of our PE firms tend to participate with us. So we believe in we are not a firm that says we are the only ones who can do this. So transitioning capability is a huge piece. So a 10-week program would mean continuous transition of capability into the portfolio company so that they can do it every time the value puck shifts. They can do a refresh on their own, but there was a significant amount of work is getting done by us. So it is intensive, but it's very flexible and aligned to what the customer is trying to solve for. Hopefully that answered your question.
Very much so. Thank you. Sumit, do you have anything to add on that one? Okay.
I would just, say, if you want to think fat numbers, this is a 6 to 8 week process after you have clarity on your value agenda. And the CEO and some of the functional leaders will spend on a weekly basis, maybe 2 to 3 hours on it in chunks of 45 minutes to an hour. They'll probably have 2 meetings a week on this. I'm simplifying it to just give you order of magnitude. This is not about, taking huge drones of time because we have production facilitating this work in the background. So think of it like 6 weeks, and 4 or 5 leaders in your business will spend a couple of hours meeting us on this. And it'll go up and down a little bit in the beginning and end, but roughly speaking.
Okay.
Cool.
Thank you. Okay, well, we're almost at time. Any closing thoughts from either of you?
Thank you very much. And please stay in touch if you have any other questions. Some of you have asked for the charts. Megan, I know normally we don't send these charts out. However, if we can create a redacted version for those who want it, happy to. And look forward to staying in touch. Thank you very much.
Thank you.
Thank you very much, everyone.